Imagine you're looking through a company's financials. Maybe one you want to invest in, maybe a competitor. You find the auditor's report, see unqualified opinion. Phew, looks good, right? But wait, there's this extra paragraph tucked in there. It doesn't change the past, but it's there. Why? What's it telling you? Welcome to the deep dive. We sift through the sources to pull out the key insights, giving you a shortcut to being really informed. Today, we're tackling those extra paragraphs, explanatory paragraphs in auditors' reports, specifically for issuers, those are the public companies. SEC-regulated PCAOB audited ones, our mission. Figure out why they exist, what they mean, and when you'll see them. So you can decode these reports like a pro. And our discussion today draws on some really solid material to get us there.
Absolutely. And before we really jump in, just a quick reminder for everyone listening, this deep dive is based on material from Farhat lectures. All the content, the examples, explanations, it's all derived from the comprehensive accounting resources you can find over at farhatlectures.com. It's a fantastic resource if you want to dig deeper or reinforce what we talk about today.
Great reminder. Okay, let's unpack this. An explanatory paragraph. What exactly is it at its heart?
Well, simply put, it's there to give you more information, some extra context, maybe emphasis on a specific point in the financials.
Okay, so it's like a signpost.
Exactly. Its main job is to draw your attention, the user's attention, to a particular topic, maybe an event, something specific the auditor thinks is, well, crucial for you to understand the whole picture.
And this is super important, right? This paragraph does not change the auditor's main opinion.
That's the key takeaway. It absolutely does not modify the opinion. The opinion stays unqualified, meaning the financials are presented fairly.
So it's still a clean bill of health, fundamentally.
Correct. And this paragraph usually shows up after the opinion paragraph in the report. It's adding emphasis, not changing the grade.
It's like saying, everything looks okay, but pay attention to this specific thing over here.
Precisely. Yeah. And, for folks familiar with audits for private companies, non-issuers under AICPA rules, this is pretty similar to what they call emphasis of matter or other matter paragraphs. So if you know those, this concept will feel quite familiar. It's the same idea. Highlighting something important without messing with the opinion itself.
Okay, that comparison helps. So if it doesn't change the overall verdict, why include it? What triggers it?
There are basically two main reasons it shows up. First, it might be flat out required by the PCAOB auditing standards. The Public Company Accounting Oversight Board says, in this situation, you must include one.
Ah, so sometimes it's mandatory.
Yes. And second, it could be the auditor's own call. Yeah. Using their professional judgment, they might decide, you know what? This specific issue is important enough that users really need it flagged, even if the rules don't explicitly demand it.
Interesting. So required by the rules, or the auditor thinks it's really necessary for context. Once it's in the report, how long does it stay there? Just for that year?
Good question. No, it generally stays as long as the financial statements it relates to are being presented. Companies usually show comparative financials, right? Like this year versus last year, maybe even the year before.
Right, you see 2 or 3 years typically.
Exactly. So if the paragraph is about something in the 2023 financials, and those 2023 numbers are shown again in the 2024 report for comparison, well, that explanatory paragraph needs to stick around too. It ensures you have the context for those older numbers right there. Keeps things consistent.
That makes sense. Keeps the context tied to the data. Okay, now let's get into the real meat here. What are those situations where the PCAOB says, auditor, you have to put this paragraph in? The mandatory one.
Right, the required ones. The PCAOB has pinpointed several scenarios they deem critical for users to be explicitly aware of. We can kind of group them. There are ones about changes in reporting, concerns about the company's future, and issues with corrections or how information is presented.
Okay, let's start with changes in reporting.
First up, a material change in accounting principle. This is when a company adopts a new major accounting rule. Think about the big shifts we saw with revenue recognition or lease accounting recently. Those fundamentally change how numbers are calculated and reported.
So if they adopt, say, the new lease standard and it really changes their balance sheet.
Exactly. The auditor must add a paragraph explaining the change and, importantly, how it affects the financials. It's a heads up that the rules of the game have changed for how the company keeps its books.
Meaning you can't just compare this year to last year, apples to apples, without knowing about this shift.
Precisely. It signals that comparability issue. Second, related to reporting changes, is a change in reporting entity. This isn't about buying or selling stuff. It's more about the company's structure for reporting. Like maybe a parent company now consolidates a subsidiary it didn't before, or it changes how it accounts for a big investment from, say, fair value to the equity method because its ownership stake changed. It changes how the overall company looks on paper.
So the shape of the company in the reports has changed.
Right. And the auditor needs to explain that shift so you understand what you're actually looking at compared to prior periods. Third in this category, a bit less common, is the material effect of investee year-end changes. If a company's results are heavily impacted by another company it invests in, an investee, and that investee changes its fiscal year-end, well, that can mess with the timing and comparability of the investor company's numbers.
Ah, like if a supplier they partly own changes its reporting cycle.
Could be. If the impact is material, the auditor has to point it out and explain the adjustment needed for clarity.
Okay, so those first three are all about transparency when the reporting itself changes significantly. What about flags about the company's health?
That leads us straight to number 4, substantial doubt about going concern. This is a really significant one. It means the company is facing major financial trouble. Think recurring losses, inability to pay debts, negative cash flows, serious stuff.
But they haven't actually failed yet.
Correct. Management usually has a plan they think will allow the company to survive. But the auditor has substantial doubt. Even if management is optimistic, the auditor is required to put this paragraph in, highlighting the uncertainty about the company's ability to continue operating for, usually, the next year.
Wow, so even with a clean opinion, you could get this huge warning sign?
Exactly. It's probably one of the most critical signals in explanatory paragraph consent. It's a major risk flag.
Definitely one to watch for. What else is on the mandatory list? Seems like we're covering corrections next.
Yes. Number 5 is correction of a material misstatement in previously issued financial statements. If they found an error in last year's numbers, maybe revenue was booked too early, or expenses were misclassified and they fixed it this year,
They have to call it out.
they have to explain it. The paragraph highlights the correction so users understand why this year's previously reported numbers might look different now. It ensures transparency about past errors.
Okay, what's number 6?
Number 6 is when the prior year audit report is not presented. Usually you get comparative reports. But if, say, it's the company's very first audit ever, or for some reason they aren't including the prior year report alongside the current one, the auditor needs to explain why that comparative piece is missing.
Makes sense. Need to know if there's history missing.
Right. Number 7 relates to integrated audits for public companies. Auditors often check both the financials and the company's internal controls over financial reporting. If they issue separate reports for an integrated audit, one for financials, one for internal controls, the financial statement audit report needs an explanatory paragraph mentioning that the other report on internal controls exists.
So they point you towards the other report.
Correct. Keep things connected. Number 8 is sort of the flip side. Management's assessment of internal controls, not audited. If management did their own assessment of internal controls, but for some reason the auditor didn't audit that assessment, that fact needs to be disclosed in an explanatory paragraph.
Okay, another specific control-related point. We're almost through the mandatory list.
Almost. Number 9 deals with omission or incorrect presentation of supplementary information. Financial statements often come with extra info, like the management discussion and analysis, MD&A. That's management's story about performance. If there's a significant inconsistency between the audited numbers and this other information, say, the income statement shows 20% sales growth, but the MD&A talks about 25%, the auditor flags it.
Ah, so if the story doesn't quite match the numbers.
Right. The auditor needs to explain the discrepancy or state that the supplementary info hasn't been audited to the same level. And finally, number 10 is a bit of a catch-all. Material inconsistency in other information. This covers any other serious inconsistency between the audited financials and other information included in the same document, like an annual report, that could mislead a user if not clarified.
Okay, wow. That's a comprehensive list of required disclosures from the PCAOB. It really drives home how much context they want investors to have. But what about the auditor's own judgment? You mentioned they can choose to add a paragraph sometimes.
Exactly. Beyond those 10 mandatory situations, auditors have discretion. They might see something that, while not covered by a specific rule, they feel is just too important to leave buried in the footnotes.
So what kind of things might trigger that discretionary paragraph?
Well, one common area is significant transactions, especially with related parties. Think big deals between the company and its own executives, directors, or affiliated companies. If these seem unusual or particularly significant, the auditor might highlight them for transparency.
Makes sense. Those can be tricky areas. What else?
Another one is an unusually important subsequent event. This is something major happening after the balance sheet date but before the audit report is issued, like a major fire destroying a factory, a huge acquisition closing, or maybe significant new litigation starting. If it could really impact the future, the auditor might flag it.
Bringing very current, potentially impactful news right into the report.
Exactly. Also, there might be accounting matters affecting comparability that don't rise to the level of a mandatory change in principle, but still make year-over-year comparisons tricky. Maybe a voluntary change in how they estimate something. If the auditor thinks it impacts understanding trends, they might explain it.
So nuances and comparability.
Right. And another big one, uncertainty regarding the outcome of significant litigation or regulatory action. If the company's facing a massive lawsuit or government probe, and the outcome is really uncertain but could be financially material, the auditor might add a paragraph just to make absolutely sure users are aware of that looming risk.
Even if it's already disclosed in the footnotes somewhere.
Yes, they might feel it warrants extra prominence. And finally, maybe if the company is part of a larger business enterprise. If it's a subsidiary, for example, and understanding its place within the bigger corporate group is important context for its standalone financials, the auditor might add a note about that relationship. And crucially, in all these discretionary cases, just like the required ones, the auditor needs to use a clear title for the paragraph. Something like emphasis of matter, followed by a description so you know exactly what they're drawing your attention to.
That's really helpful. It prevents confusion about why the paragraph is there. So wrapping this up, what's the big picture takeaway for someone reading these reports? It feels like these paragraphs are critical signposts.
They absolutely are. Understanding them is key to reading between the lines. They move you beyond just the pass-fail opinion. Explanatory paragraphs are the auditor's way of providing vital context, pointing out risks, or highlighting significant changes without actually qualifying their overall opinion. They are subtle but powerful signals.
They guide your attention to what really matters for interpreting the numbers accurately.
Precisely. They help you grasp the full story, the risks, the changes, the unique circumstances behind the financial statements. They are, in a way, the auditor telling you, pay close attention here.
So a final thought for everyone listening. Now that you know about these explanatory paragraphs and what they signal, how might that change how you look at a company's audit report next time? What hidden layers or crucial details might you uncover by paying closer attention to these specific sections? Something to definitely consider.